10-year note Treasury yields push higher early in the session, getting as high as 297. Didn't quite get to that 3% level. We haven't been north of 3% since November of 2018, but we are right on the cusp of it. But as we got closer to that level, we did see a reversal later on in the session, taking us all the way down very close to 280. So a big reversal from 297 down to 281 in yield. Obviously, that means prices are rising. Yields are going lower before settling right around 285. So a little bit off those low yields, but clearly a reversal of what we've seen recently here as 10-year note Treasury yields have made a tremendous run higher in 2022, closing out 2021 at around 1.5%. Getting up now close to 3% means that we've almost doubled the yield in about a matter of 3.5 months. And today, seeing yields holding steady as we speak at around 285. Now, what does this all mean for volatility? Well, if you check out that CVOL index over at cmegroup.com, you'll notice that as yields have been going higher, volatility has been going higher as well. Today we saw a little bit of a pullback in volatility, but it really has been more steady. And if you look at where we were late last week, we've actually seen a pretty significant move higher. As we get closer to those major thresholds like 3%, volatility has been moving higher. Today we did see a little bit of a pullback, but clearly still higher on the week and ahead of some key news information coming out tomorrow. The market waits with bated breath. Now, what do we have the rest of the week, or what do we have tomorrow, I should say, on Thursday? Well, we get that claims number. It's our in-the-moment look at the jobs report. Used to be very important, used to be highly watched. Now, as the jobs are not really a key focus right now of the Fed, they've become a little bit less watched, but we do keep an eye on them. We are anticipating about 180,000 new filings. That is going in the right direction. That is going lower. That is the way the Fed wants it. We also get the Philly Fed Index. Now, the Philly Fed Index is looking to be weaker than it was last month. That's not something the Fed wants to see. Clearly, they want to see the economy expanding, and they want to see growth numbers coming back. That GDP number, GDP now, I should say, anticipating about 1% GDP in the second quarter. So right now, we are, Fed wants that number to be higher. A lower Philly Fed doesn't help. But lastly, the highlight of the day on Thursday will be Mr. Powell, the Fed chair, speaking to an IMF panel with ECB President Lagarde. At this point, anything he says, anything the Fed chair says is going to be heard and listened to very closely. And obviously, with the Fed starting their rate hike cycle in March, raising 25 basis points with the anticipation of taking rates really all the way up to 2.5% by year end and possibly close to 3% by the middle of 2023. Market would like some clarity on that. Right now, the expectations are inflation may have peaked, and the Fed chair will likely talk about the high elevated inflation levels, as well as the Fed's possible path as to how to fight it, raising rates and shrinking their balance sheet. So that will be obviously very closely watched by most market participants. So 10-year note yields, after extending higher again, almost at 3%, see a modest pullback ahead of tomorrow's Fed Chairman Powell testimony at the IMF.